Yeah.
I'm trying to do it now.
Silence.
Yeah. Wait on the IT part?
Becky's trying to get logged in and see if Vicky Frederick
Oh, I got you.
needs to be moved over from its duties.
I saw Carl Becker on the retirement list.
I know, I saw it too.
Yeah. And I didn't hear it.
Why is that name from?
She was Tom Curran's assistant.
That's right, that name was so familiar. Yeah, that's right, now I do remember.
When we were,
Uh,
Ellie Meyer.
was 69 years old. We just-
Well, good morning, everybody. So yesterday afternoon, Jim Kinane resigned from the board. As such, the board has no chair and no current vice chair. As secretary to the board and remaining officer, I will conduct the meeting today. And so we'll call the meeting to order with roll call. Brian Hanson,
Present?
Paul Hample,
Present.
Lieutenant Colonel Joe Lure,
Here.
Jody Patterson.
Here.
Anthony Waskowitz.
Here.
Milton Wilkins.
Here.
All right. And Paul, welcome. New to the board, first meeting, a wealth of experience with boards and commissions. Look forward to getting to know you better and working with you.
Thank you very much.
So we will first order business approval of minutes, section 2, item A, retirement board meeting of August 29th, 2023. All in favor?
is there a motion to approve?
Is there a motion to approve?
Well, make a motion.
Second? All in favor?
Aye.
Any objections?
So far, so good.
All right. Section 3, request for benefits, item A. Employees requesting retirement benefits. There are 20 civilian requests. Motion to approve. So,
Anything unusual? Okay,
So move.
second.
all in favor?
Aye.
Any objections? All right. A2, 2 police requests. Becky, anything?
No, nothing unusual.
Okay, I move to approve.
All right. All in favor?
Motion to approve?
Second.
Oh, I'm sorry, I didn't hear it.
Okay, motion, no second.
All in favor?
Aye.
Any objections? Section B, corrected retirement benefit requiring board approval. There's 1 civilian request.
This is a request, when we do pensionable pay and factor that all in, when I did this back in, I think it was May for this employee retiree, I did not include longevity pay. And so I went back and recalculated it and got it updated. It wasn't anything substantial, but, you know, to be fair to the retiree and, you know, make it official, we'll need board approval for that. So my apologies.
I move to approve.
Second.
In favor?
Aye.
Objections? Item C, beneficiaries' applications for death benefits. There were 4 civilian requests.
Move to approve.
I'll second.
All in favor?
Aye.
Aye.
Objections? Item 4, a discussion of board vice chair position. Up to the board, but maybe consider tabling until another meeting.
I suggest we just table it until the next meeting.
What's gonna change at the next meeting? We not have the discussion now?
I think part of it might be finding a chair, which we might want to do at the next meeting.
Gotcha, okay.
You want to discuss it at all, Jeremy?
Let's see. So, Phineas, performance report, ACG Consulting Group, got items 5 through 9. It looks like.
Yeah, I got a lot of them today, so I feel sorry for you guys. No, it'll be good. What we have today is, first off, just, typical market review performance update through August 31st. I'm gonna start with that and go through that. And then we do have 2 items. As a reminder, we do these annually. First is just kind of review of overall active asset implementation. Certainly it affects our managers and how we think about selecting managers. But it's really just a tremendous amount of data from the industry. So I'll go through that. Also have just every year we look at our investment policy statements, see if there's anything we can clean up, language we can change. So we do have just a few quick tweaks, but really nothing really of substance too much. And then finally, just there was a little follow-up from last month, just around concentration in the large cap equity universe, particularly in the S&P 500. 7 names really driving that. So what's our exposure there? So that's what I plan to cover as we go through this. And first, I will start with just our portfolio. So it's a staple piece. It says market update and portfolio review. So as we start with that, so really now is this, we talked quite a bit about the markets this year, and we know kind of generally what's happened. Again, really everything has been, market sentiment has been driven by movements in the interest rates. And so kind of here on this first page right here, just again, a summation of the market performance. And you can see really I'd focus on kind of this kind of table right here on the left-hand side in the middle, just index returns. But again, 2022, certainly we know the uncertainty around the real sharp raise in interest rates. Kind of the Fed has been out there saying, listen, we are here to bring down inflation and we're going to do what it takes. And so saw a lot of that kind of really hurt both equity and bond markets last year. This year, we started to see certainly some of the Fed, some of those rises in interest rates. We've kind of seen that kind of play out in some of the economic news, starting to help people be a little bit more confident, not need to be as aggressive in rate hikes this year. So markets really have rebounded tremendously, and you see that. That's just that right-hand side of this graph, the light blue bars. You can see really across the board. Bonds are positive, but really strong jumps in equity market performance so far this year. We did see a little bit of pullback, and that's that dark blue bars on the left-hand side, August to the negative side. And then we started to see that continue here in September. And really a lot of it has to do with Jerome Powell, the Fed, continuing to come out and say, listen, inflation, it's not where we want it to be. We continue to want to, continue to raise interest rates, make it more expensive to borrow, harder for folks to spend money, kind of even push us towards this recession if need be. So overall, we've seen a pullback really in the last month or two, but continuing, take a longer term approach past just the last 6 weeks. Overall, 23 has continued to be very strong market performance, something we've seen in our performance report. And so just to hop to the numbers, and I do want to make one point out here. If you look at page 4, so these are, this is our portfolio as of August 31st. So first and foremost, $820 million in the portfolio. That's in the top left-hand side of the page. and we'll go through the returns in a minute that got us there. But I do want to point out, and again, as always, we compare ourselves every month to our asset allocation. And on the right-hand side of this page is over and under targets. And you can see this looks quite a bit different than it usually does. Typically we always try to be within plus or minus 5% for various asset classes. You can see underweight fixed income by quite a bit, but then there's a corresponding overweight to cash. And again, this had to do with that transition from Silchester. We kind of went through that calendar with the board and everything. And so ultimately, at the end of the day, we had some liquidity with Western that we pulled out. Our Sanderson money went to cash, and then we quickly turned around and funded that back to Silchester. So everything has taken place. If you were to look at this as of today, we'd be well within our bands, and we've moved on from Sanderson and funded Silchester as of the start of this month. But again, we had talked about this. We knew it would cross over a month end, and just so everyone kind of knows everything that did happen.
Just a quick question. It looks like the two areas on the previous page, page 3, that you have rated as overvalued are large cap, US large cap and real estate. Those look like our two largest overweights. Is there any rebalancing we should be doing, or?
So we continue to wait on money from REEF in our real estate portfolio. Again, they put the queue up to pull some money on. So we put a $20 million redemption in, and we've gotten 7 back so far. So we still expect some of that to come back. And then as far as US large cap goes, this continues to be our funding source. So every month we're talking with Vicky, and we're pulling out $2-3 million from the portfolio, and we continue to use it, whether it's from Runline, particularly Jennison a lot this year, given how much they've kind of ramped up. And so ultimately, we do continue to think, listen, it's a very frothy, expensive space, and that's why we're looking to take some of our profits there. We don't necessarily think it's at a level where we need to kind of make a tremendous rebalance to, but we can, just so you know, we're taking $2-3 million, like I said, out each month. We've done that pretty much all year, so continuing to try to pull that back in line. Any other questions just on overall asset allocation, and then we'll flip to page 5 as it looks at performance. Okay. So again, we saw a little bit of pullback in the markets in the month of August, and that's that 1 month column. And so you can see we're down 2%, pretty much right in line with our benchmark there. But you can see definitely different stories. You look to the column to the right, year to date. So this is through the first 8 months of the year. You can see we're up 8%. And again, just for Paul and others who are new, everything we're showing is net of all investment manager fees. This is returns after the fees we pay. So we're up 8%. And we compare ourselves to 2 different benchmarks. The first is our strategic policy index. And so really, if you look at the previous page, Paul, what our target asset allocation is, that's 63 equity, 22 fixed income, 15 real estate. That's what our strategic policy is made up of. 63 equity, 22 core plus bonds, Barclays Ag, and 15 to the Odyssey, the real estate index. Now, so you can see year to date, we're slightly above that from a net of fee perspective, up 8%. The broad policy index, again, basically, if you look at that previous page 4, it's really just simply moving real estate over to equities. So there's no real estate within our broad policy index. Real estate has taken a hit so far this year, really protected us last year, great diversifier for the portfolio. But again, it's really still got some of the reasons, the impact of interest rates, certainly a lot of borrowing in this space. To Brian's point, why we think it's a little bit overvalued, that's certainly come down this year. And so, but that's not in our broad policy index, and so that's why we trailed there. But we would expect that, no major concerns. Just looking a little bit longer term, so for the year, again, this includes really kind of the last 4 months of 2022 that continue to be part of the downturn, particularly in September and a little bit into October. So that's why our returns a little bit less. We're slightly behind our policy index. You go out further to the 5-year, certainly we had 2022 in there. We had 2020 in COVID, even part of 2018, which ended up being a pretty volatile year. But overall, kind of, you can see we're up just about almost 5.9% over the 5-year. So just right on top of, a little bit ahead of our policy index. And then over the last 10 years, we're up almost 7.4%, 7.36. And that's a 30 basis points per year outperformance versus our strategic policy index. So long-term continued strong performance.
Next question.
Yeah, no.
The real estate performance year to date, 5.21%. That is through what period?
This should include, let me just pull it up. So this is through, the quarter end. So this would be through June 30th.
So it's really outdated.
Yeah. It just, and that, that also, that's the same thing for the Odyssey as well, which reports quarterly as well. And so there's somewhat of a lag there, yeah.
Can you remind me the duration on IRNM and Western?
I'd have to double check on that for you, Brian.
We had Western present earlier in the year and they were kind of long duration.
So they are, and I think they still are. I
So
don't
it's
know.
probably going to be an ugly September too.
Yeah, so they've certainly kind of, Western, as you can see, has been impacted, you know, particularly last year, 22 was a pretty tough year for them. And that's what's really kind of driven there. If you look at that 3-year number for them on page 7, that longer duration certainly kind of hurt them relative to the benchmark. But again, that's kind of somewhat their MO, and they've, you know, continued to load up on yield. And
Well, but that was also probably what got them into the Credit Suisse AT1.
yeah,
It's-
they had that exposure. That's right. We went through that.
Yeah.
Maybe just a couple other points on really kind of what's driving some performance. And you know, I think one of the benefits of having these paper copies, you're making comments beforehand, it's a little bit easier to flip back and forth. And so I don't want to make people flip too much, but I'm going to focus on the year-to-date column again. So this is 2023 performance overall. And just on page 5, you know, hitting some of these kind of composites again, as we want to think about this, individual manager is very much important, but it's how they work together relative to what else we have. So obviously kind of very strong performance rebound here, particularly in U.S. large cap. Again, really led by growth sectors, technology. You can see our 3 managers in aggregate up over 20.5%. So you can see that's almost 2% ahead of the benchmark so far for the past 8 months. So strong performance. Really, you know, that's led, you know, Jennison, that manager of ours, who really kind of overweights technology. And we're going to show that here in a minute. We have this kind of breakdown of their holdings relative to the benchmark. But you can see if you flip to page 6, again, Aristotle definitely having a nice rebound on the value space relative to the Russell 1000 value, up about 3.5% year to date. You can see Jennison up almost 39% year to date. Again, that just shows some of that divergence, that difference in the growth sector versus value so far this year. And so you can see that's not only has growth done well, but Jennison, as we'll see, overweight some of these, you know, names who really rebounded this year. So adding some strong performance overall, about 6%. You don't necessarily need to flip back, but just our 2 small cap managers, Ernest and Granite, you can see them here on page 6. But just so you know, in aggregate, year to date, they're up about 7%. That's a little bit less than the benchmark, but over the last 12 months, they're up over 2% relative to the, in aggregate, relative to the Russell 2000. And so you can see Ernest, you really kind of right on top of its benchmark this year. Granite trailing a little bit so far this year, but you can look over the last 4 months of last year, the past 12 months, and you can see some strong outperformance from Granite. And really both these managers in general, and you look to the longer term since we've added them, really been able to add quite a bit of outperformance as we would expect. Sanderson gave us a nice parting gift. You can see again, we are out of them as of August 31st in the portfolio, but through 8/31 for the last 8 months, you can see they're up almost 20%. So really kind of a strong rebound. And then they talked a lot about it. And again, as a reminder, we talked a lot about actually from their philosophy and process. We didn't have much of an issue with what Sanderson was. It was more so from the firm standpoint. Qualitatively, they continue to lose a lot of assets.
Have they wound down yet?
Would you say, Bill?
Have they completely wound down yet?
So they, yes, they have. So everybody's out as of August 31st. And again, I think it's just, you know, it's a great reminder why, you know, we look at the qualitative issues, why that's so important. You know, we started talking about this months ago, and it takes us time to find, you know, new manager and kind of make that change. But again, Sanderson was getting so many clients redeeming, they ended up shutting down their fund as of August 31st. We talked a little bit about that last month. So again, we were able to, when that happened, we already had a suitor in mind and we knew where that money was going. And again, starting next month, we won't see Sanderson anymore. We'll see Silchester on this docket. So, but again, so not only Sanderson strong performance, but then WCM, you can see continue this year. Again, they have a little bit more of a growth tilt in their portfolio. On the international side, that factor's been more muted this year in terms of impacting. But overall, WCM continuing to add some strong performance for us. Mondrian, so we've talked to Mondrian, I've told you, we've been in their offices in London, they've been over here. They are actually coming in person to our meeting next month in October. So we're gonna continue to talk to them again. They're very much a quality focus. It's a little bit valuation, but much more quality in their portfolio, which on the international small cap side just really hasn't worked so far over the last couple of years. And so they've been out of favor. So they continue to kind of stick with their guns. They're still invested in the same philosophy and process. We're going to bring them in here and let them kind of talk to everyone. Again, that'll be next month. They'll be here in person, PMT. Acadian on the emerging market side, emerging markets, itself have been, I'd say overall, the different areas have been strong so far this year. China has struggled, and we've seen Acadian been, pretty good underweight to China. That's really helped their relative performance, and you can see the year that date really strong outperformance. Both our bond managers positive returns so far this year. As Brian mentioned, I think we'll see IRNM tends to be a little bit shorter than the benchmark. So actually, I think they'll probably hold in better through September, but Western we'll see from an outperformance perspective. And then finally, you can see year to date, just look at that column again. That's just through the first half of the year. As we've mentioned, real estate, some of its valuation, some kind of interest rates have hurt over the past 6 months. You can see overall our managers have held them pretty well. But again, I want to point out it's been a tough, year to date, 1 year, but that 3-year number, all of our managers up 7.5% to 10%. So again, that just goes to the strong performance they gave us in 21, 22 as well.
Can I make an observation?
Yeah.
Just to keep perspective on the numbers. At the end of 2021, the portfolio approximated $966,057,000. At the end of 2022, it was $760 million. It declined $205 million in 12 months. Now we're back to 820, $665,000. So we were down 21% last year versus 2021. And now we're only down about 15% versus 2021. But we're still in the hole versus where we were in 2021.
We're 2021, yes. Now you can also look at that. We have these in our quarterly books, as you guys know. But if you look at the first quarter of 20, so again, that was kind of before that big rebound in 20 and then into 21, we were kind of down even further from there. And even, you're exactly right, everything you said, but keep in mind too, we're still pulling money out of this, each and kind of every month. So that's also
Nevertheless, the dollar value, I'm not talking about the percentage so much, dollar value has declined 15% over this period of time, whether it's performance or withdrawals. And that dollar value affects our funded ratio. Funded ratio went from 85% on a market value basis down to 65% at the end of last year. Now I think it's at 69 to 70%. It's still way under where we
And
were.
I just point out, even though that we've had the risk-free rate raise anywhere from 300 to 500 basis points, depending whether you're looking short or long, our discount rate has stayed the same throughout. So the value of government obligations has declined dramatically. We'll see that next month when we're seeing the fixed income managers, but we have not adjusted our valuation metric at all.
Well, we'll do that in May or June, actually.
Okay.
I think June is our usual timetable. Maybe May. Because then we get the actuarial report in July. Decide what we're going to do.
That's just an annual vote. Discount rates an annual vote.
Yes. And Tony, maybe you weren't here the last time, perhaps not. But what ACG does is provide us with their best thinking on projected asset class returns and the structure of our portfolio. But I also get Morgan Stanley's asset class returns, as well as Morgan Stanley and Mercer. And so we look at all three plus ACGs to try to come up with a reasonable expectation. Not saying any one is any company or firm is definitively right and another firm is definitively wrong. But just to understand the range of opinion or judgment, analysis of 3 to 4 outstanding firms, just to test reasonableness of our ongoing projection ourselves for our portfolio, given our asset mix.
Okay. Thank you.
Hey, question on performance? I did maybe quickly we transition again, stable piece to large cap equity discussion. This was a follow-up from last month. It's certainly, I think, very timely, and I think it hits on first off just what's going on in the marketplace, but also diversification amongst our managers. And so if you want to just flip, it's page 3 is the first one. So we've talked a lot about this. If you heard the headlines, now it's the Magnificent Seven. They keep all these different phrases for different investment acronyms and groups. But it's the companies you see here on this page. It's Apple, Microsoft, Amazon, Alphabet, which is Google, NVIDIA, Tesla, Meta, which is Facebook. So again, these kind of very strong technology, somewhat different sectors, but technology companies who've experienced tremendous growth really over the last several years, but even in particular here in 2023. And we talked about this earlier, I think last month. So year to date, the S&P 500 is up about 20%, and over 10 of that percent is attributed just to these 7 stocks. And the other, it's almost 10% now is coming from the other, 493. And so what kind of an important distinction to make, you guys, when we talk about the S&P 500 being a market cap weighted index. What that means is, so this is the benchmark, it's the S&P 500. It's the largest 500 companies in the U.S., but they're all not weighted equally in that index to come up with their return. They're based on their overall size. And again, when you think about the size of a company, really it's simply quite their value is their share price times how many shares are outstanding. That's how much the company is worth. And it really speaks kind of its impact on the economy. Well, the S&P 500 is weighted by how big the company is relative to each other. And so that's where this S&P 500 line, these 7 different companies, this is their weight within that index. So Apple is the largest. The S&P 500, it's almost 8% of the index. And so you can see in total, it comes over 25%, 27.7% of the benchmark. And so kind of the question is, well, how are we allocated to that? How do we compare? And these are our 3 managers. So first off, Rumline, passive, core, in the middle. Not surprisingly, as we wanted to, it matches the index. When we sign up for Rumline, we're signing up for passive exposure, index exposure. Aristotle, on the value side of that spectrum for us, you can see actually has very little exposure to these 7. It has an allocation to Microsoft and actually less than the overall S&P 500 does. Conversely, we talked about Jennison in there. Jennison has been this manager at times. It's had really, really great returns for us, and sometimes really poor returns. And that's because their focus, again, is what they call these ultra growth, large technology weights. And you can see pretty much across the board here, not only have exposure to these, but pretty significant overweights, particularly if you think of NVIDIA, Tesla, relative to what's in the benchmark. So in aggregate, almost half of their portfolio, 41%, is allocated to these large 7 names. So again, but this is why we have diversification in our portfolio. Jennison's been great for this year. We just highlighted that before, up almost 40% in 8 months, 6-7% ahead of the benchmark. But you bring these 3 together, and in aggregate, it's 25% of our large cap portfolio. So those 3 managers in these 7 stocks. So relative to the S&P 500, we're a little bit underweight relative to what's there. Now, from our total portfolio perspective, so all of that $820 million that we were just referencing, it's just about 7% of our portfolio is in those 7 different companies. And so again, that just has to do with the U.S. large cap space, one of the largest, most liquid areas in the world. These are the largest companies that we invest in. And so that's kind of certainly what our exposure is. The question is are we happy with this exposure? And I think kind of first and foremost, this in some ways is what the market is. We sign up for broad market exposure, obviously with Rumline, but we also with our active managers, kind of to be invested with what's driving investment market returns. Now, one thing we did put together, which is a comparison, it's on the next page, page 4. is somewhat the difference. So think about, again, the S&P 500, what I said, this market cap weighted index. So again, it's the biggest players have the biggest size in that index. You can invest conversely in an equal weighted index. And that's just simply taking, this is the S&P 500 equal weight, taking the 500 largest companies, and everyone is the exact same size within the index. And frankly, somebody need a crystal ball to see who's going to do better in each individual year. And I can, certainly it was particularly starting in 2015, really 2017 going forward, we've seen really strong outperformance from these, large cap, heavily dominated in the market cap index. And that does, we don't have year-to-date 23 on here, but certainly that'll be another year driving. And so again, and actually what you end up finding in our equal weight index, and this speaks to the diversification of the overall portfolio, you get to some of the smaller mid-cap names in the portfolio, which we're getting exposure to through our Earnest and through our Granite as well. So overall, we're comfortable with this exposure, kind of in itself in a vacuum, it seems a lot that we have just, 7 names with this amount of exposure in our portfolio. But overall, that's what's kind of how the market has gotten. It's been really driven by some of these larger mega cap names continuing to grow. But overall, we're not as exposed as the S&P 500 is, but we're also certainly through the benchmarks so we can appreciate and grow with that. And also why we diversify within our managers, because they each three are quite different.
What are fees on the equal weighted passive products? Are they similar to the?
Pretty similar. I can check. They're like a couple basis points more. They're very similar to we're able to through a Northern Trust or State Street, for instance, has these, and we can you can get large cap for 1 or 2 basis points. Equal weight would be under 5 basis points.
Okay, I'm just wondering. I mean, when you sum up our value and our growth allocations, you get almost back to your market cap weighted. Would you get more diversification by doing 60% market cap weighted, 40% equal weighted, and then bring the fee down?
Possibly returns as well,
True. I mean, that's the, I mean, like you said, some years
Some years you do.
you just don't know. But when you take 60% passive and then you have 20% active or 20% value and 20% growth, at the end of the day, at least concentration to those top 7 names, you come up, you're only 200 basis points below. So I don't know how much risk mitigation we've done by taking the satelliting value and growth. Just a thought.
Phineas, I seem to recall you quoting, and it may be my imagination, what the returns were for the S&P 500 and the equal weighted S&P 500 in the month of August. Excuse me. Yeah, month of August, or maybe you quoted something for September year to date.
I don't, so year to date, it would certainly be the market cap weighted would be higher.
Yeah.
I don't have those numbers on. I mean, we can look at the S&P, we have that. I don't know what the equal weight is though through the month of August.
Yeah, I want to say the equal weighted is like 5%. Whereas the S&P, the nominal S&P 500 is substantially above that. It's been a very interesting year because so much of the performance has really been concentrated.
Right.
This count, because it's
Especially in the
grown up
first
since
half of the
first
year.
quarter. First quarter, those companies, I think it was 9 companies represented 91% of the 7.5% return for the first quarter, and it's broadened out since then. But it's still not.
This year would be a big dispersion year.
In other words, being in the wrong place in the wrong time could be very painful.
Well, I mean, it certainly is,
It's an
it's a decision to make. I mean, it's, this is an active decision, even if it's a passive investment, it's an active decision to be different than kind of with the broad.
You would then be 100% passive. You would save fees, but you will always be either over or under based on your allocation to the equal weight as opposed to
And this year, I think it's
the market cap benchmark.
And this year, I think it's 8 to 10%
Significant.
under.
Right.
The equal.
Yeah.
Please. It's hard to make that up in fees.
Yeah, well, I'm not, I don't disagree. I'm just, again, from a concentration perspective,
Yeah.
this is one way of mitigating, and what we've done, it doesn't mitigate our exposure to the concentration risk. So
Any questions on that? I mean, ultimately, we continue to recommend investing the way we're investing.
That's fine, yeah.
But again, I think it's certainly worth, bringing attention and pointing out.
I don't think anybody's arguing for a shift.
No,
I just think it's very interesting. to go through an
I just wanted to,
see
yeah.
what the facts are.
Benny, maybe just to put a finer point on that, what the tricky part is, if you manage the concentration risk, you're then taking a lot of basis risk relative to the benchmark.
Right.
Too. And I don't, so you could be thoughtful from a risk management perspective and underperform.
Again, I mean, as somebody who spends more than half their time in the active world, as we spend time in the passive world too, I just remind you that tracking error is the risk that the manager gets fired. Because if they
Yeah, right.
underperform for a long enough period of time, they get fired. Tracking error, I mean, yes, we can look at something. Permanent loss of capital is what you're trying to protect against.
Yeah, that's good.
And when you have this concentration in 7 names, and when you break it up, the way we're managing that risk is not really managing that concentration risk.
And of course, this is a piece of our overall portfolio. It's a piece of our overall equity portfolio. It's a piece of our overall US equity portfolio. And again, I guess it's in the IPS. And ultimately, our goal, yes, we want to prevent against loss, but in everything, we need to hit our bogey over a long period of time. And so we kind of want to make sure that we have exposure to these areas. Sure. And it's certainly, it's a very different discussion saying, let's put the whole St. Louis County portfolio in these 7 names. But obviously, again, but if we want to think about, we want a certain exposure, and we model this every year that we were talking about, Milt, to the kind of broad US equity market, these names are a big part of that. So we want to, making sure we have that exposure there is very important.
Again, I just reference you back to,
And it's not as though they're a big part of it, but they're standing still. It's not as though they've achieved number 1 or 2 position and they plateau out. That is self-correcting. If somebody else begins outperforming them, that is self-correcting.
I only raised the issue because it's the sector that you have rated as overvalued. And so I was trying to figure out, is there a way we can mitigate some of that overvalued risk? And I'm not sure what we're doing is necessarily mitigates that risk. It just, it breaks it up and brings it back together.
Great.
To the extent that these 7 are leading to your assessment that large cap is overvalued, I'm trying to figure out, okay, is there something we should be doing to mitigate that risk to allocating to an overvalued sector?
Brian, you're using the word overvalued.
I'm using their word.
Are you talking overvalued or overweighted?
So
So
overvalued.
So yeah, from a price standpoint, we do continue to believe that kind of large cap relative is pricey, is expensive, is frothy. But again, like everybody else, we don't know exactly when that's going to turn. Having that exposure is there. I think, we like the ability, we're mostly passive in our portfolio, so we're taking the market exposure, but we do add the active wings on the side because we think that does help underweight some of these areas that are the richest. We're not, I wouldn't say hugely underweight those top 7, but we're somewhat
Right.
underweight those top 7. And so kind of having that active manager perspective helps.
That's what they're being paid for.
Yeah.
Yeah, I'm sorry, I don't want to keep belaboring this point, but I did appreciate on page 3, your total exposure. These 7 names are 6.9% of the portfolio, but when you even look a little bit closer, so 2 names equal 3.3% or have a 3.3% weighting in the portfolio. And so just at a high level, if someone said 2 positions in the portfolio make up 3.5% of the portfolio, is that proof that? And I don't know the answer. I'm just saying that to me, that's I think a point of interest that we should at least be attentive to. And I appreciate you calling it out. And to me, that's significant, right? I don't know what to do about it because not having exposure also creates risk, but that's a big position, for a pension plan to have. But again, not having that exposure creates.
Just also, it's an opportunity cost, as it turns out.
So if you could just make sure nothing happens to Apple and Microsoft.
I mean, I think, no, it's, I mean, right, these are two, these are kind of the large positions, but again, this is, we're not necessarily making, the marketplace is kind of making the decisions about how big they should be relative to the other companies out there. I think from a pension plan's perspective, 2-3% certainly, I don't think that's overly, something that's going to take down the pension plan, but it also helps who the companies are. Apple and Microsoft are two of the most well-capitalized companies in the entire world. And so this isn't necessarily, a startup early that we're moving all our chips into things kind of really take off the bus. But kind of, again, very well capitalized, very well seasoned, and tend to go to the opportunity cost of not being in there, certainly.
If you took a 10-year period and the equal weighted S&P 500 outperformed the nominal S&P 500, then you come to perhaps a different position that you ought to do something a little bit more elegant than what we're doing. But you can't come up with that 10-year or that 8 or 10-year period where that is actually the case. So the market is market. We participated in it. And the guys who are big for a reason. It's not as though they may be overvalued at any point in time, but they are where they are for a reason.
2001 would argue that sometimes the market gets a little
Oh, yeah.
off kilter.
Yeah, that was a disaster. It was a catastrophe. Everything went down. Well, value stocks did very well in 2001. You recall, you made good money in 2001
Right.
and money in 2002. It's 2003 in the year 2000, value stocks made 2001, a lot of money. 2001, they made good money, not a lot, but good money. It was in 2002 that everything crashed. Recovered in 2003.
Yep.
But you look at Facebook or Meta, they were down over 50% last year. One year they were down over 50%. This year they've more than doubled. So what is overvalued at one point in time can turn around very quickly. And if we had an equal weighted portfolio, we would certainly be underweight. We would have been we wouldn't have gone down as much last year with Meta. We also wouldn't be up much more than it went down this year.
I guess I would argue what took these and other growth names down in 2022 was rising interest rates
Yep.
and long duration equities, right?
Right.
Same thing that happened to long duration bonds.
Yep.
And then you go through 2023 and we now are talking about growth and inflation until 2 weeks ago. And now we're seeing, started to see equities pull back, but not to the extent they did last year. And so we've got there's a similar conditions to what were prevalent and cost us a lot of money last year.
I would add another expectation in 2021, or excuse me, 2022. The market crash. There was an expectation that the economy itself would veer off, go off the rails, and that didn't happen.
No.
And that's why it recovered so well in 2023. Because interest rates now are much higher than they were in 2022, and the market hasn't traded as it did last year. And it was because of the outperformance by the economy, usually the expectations for the economy. Okay. We're just having fun.
No, it's good to know what we're exposed to. And again, I think going back to kind of the modeling exercise that we do, everything has its role in the portfolio. If there's no other questions on that, so and then this one, again, this is the bigger book. There's a lot of data in here, we're not gonna necessarily go through all the pages, but I do want to explain what we're looking at. But this is, we do this annually at ACG and we present this annually to this board. Again, we call it our active passive review, but what we're doing is we're looking at kind of data throughout the industry. And really this helps set our expectations as we think about asset allocation, or I should say from asset allocation to manager implementation, where and how should we think about incorporating active management? Where does it make sense? So that's kind of what we have here. And so there's, again, a good amount of stuff, and I'm going to take us through this, but in tab 1, page 5, just quickly what this is. I was going to just start with the background up top, and then we're going to kind of dive into some of this. But so what we do, kind of our biggest data, the data provider we use, really is probably one of the most prominent in the industry, is eVestment Alliance. eVestment Alliance, pretty much all managers, active and passive, this is where they report their data to. And then people like myself and even managers pay for subscriptions, and we're able to kind of dissect and get all this data. And so there's over 41,000 investment strategies within eVestment Alliance. And this is really just centered on public equities, public fixed income. So it doesn't incorporate, that 41,000 doesn't incorporate private equity, real estate, hedge funds. This is kind of public asset classes. And so this is the data that we are using. They report what their fees are, what their performance are. And so we can look at gross of fees, net of fees, everything. And so again, what we're trying to look at here is for each different asset class is look at them respective to their respective benchmarks and kind of how all the managers rank within these different asset classes. Again, what we're trying to do is just see, does active management pay off? You know, obviously we know we're paying fees in this space. Does the returns typically pay off for managers? And as we talk a lot about it here, things can be time period specific. So we're going to talk a lot about what the median manager in each asset class does. We're going to use a lot of rolling periods. We use a lot of rolling 3-year periods. When I say rolling 3 years, that basically means every quarter end, you know, January or December 31st of 22, we're going to look back what the 3-year performance was. And then March 31st of 23, we're going to look back what that 3-year performance was, and so on and so forth. So again, it's kind of this evolving picture, not one static period of time. So again, I'll explain all this, but that kind of really is the high level. I want you to know, again, there's a lot of data, 41,000 different managers, kind of, you know, 10 to 15,000 different investment management firms reporting all their information here. And we're going to look at this a couple different ways. So again, maybe flip to page 6 just to kind of dive right into it. So what this is showing you, for each of these, I'm going to start on the left-hand side of the page. Those 41,000 strategies fall off into kind of basically several of these different asset classes. Within U.S. large cap, there's managers that are core. So again, they're just, you know, they're not growth or value, they're in between. There's large cap growth managers, there's large cap value managers. There's managers who identify themselves as SMID, so kind of the small and mid cap together. There's core, there's growth, there's value. There's U.S. small cap, core, growth, value. We have with international, again, core, growth, value, also international small cap, which we do have exposure to. We have emerging markets, and those are all kind of lumped together, and then within fixed income. So what this is saying, this one is time period specific. This is not a rolling. What we are looking at is in each of these different asset classes, all those 41,000 different managers, we assign them, and for each asset class, we rank them, right? Percentiles, which we do every quarter. 1 is the best, 100 is the worst. This is the median manager in each asset class. So the 50th. Half managers did better, half did worse. Net of their fees that they report, how do they do relative to their specific benchmarks? And so what you can see, and you know, this is obviously red, we're highlighting, they underperform. Green, they outperform. Again, this is the median manager. So half did better, half did worse. And so what you can see over a shorter period of time, particularly with international, it was a struggle. More than half the managers underperformed for the year 2022. And then a kind of few growth certainly kind of took a hit. And I would argue it's probably not surprising than large cap growth, mid cap growth, small cap. Again, kind of we talked about with Jennison last year, kind of overweight some of these high growth managers that sold off. Looking at the 3 and 5 year, kind of what do we see? Longer period of time, much more green on this page. Now we talk a lot about this. U.S. large cap is one of the most efficient asset classes out there. What do we mean by efficient? There are a ton of eyeballs on it. Everyone and their brother has analysts dedicated to Apple, to NVIDIA. It's hard to get an information advantage there. So we actually see that's always tend to be the hardest place to add value after fees. But as you get into more inefficient spaces, small caps, mid cap, international, you can see again, in most of these areas, more than half of these managers did outperform net of their investment fees. Again, this is time period specific. We'll get into some more rolling stuff, but over the 3 and 5 year period. Does this page make sense? So one thing that we also think is important is not just, if you kind of think about it, I was trying to use a baseball analogy with this, like, there's, magnitude and consistency, right? So it's kind of like that OPS, slugging plus on-base percentage. But that's, a little bit what we're trying to get to too. So page 6 that we talked about, it's not just did they outperform, yes or no, but look at some of those magnitudes, right? Particularly within small cap growth. The median manager was up 3.6% per year over the last 3 years. You can see international, sometimes almost 0.5%. So, SMID cap, kind of 1 to 2%. So that's magnitude. Well, what's consistency? And so that's what we're looking at here at page 7. Again, we dissect all the data, and this is for those, again, that static period of time ending 2022. But what percent of the time, what percent of the months over the 1 year, the 3 year, the 5 year, did the median manager outperform its benchmark net of fees? So in other words, I'll start with the first, large cap core. Over the last 3 years, so what is that, 48 months? 36 months, I do the math right. 42% of those months, the median manager outperformed its benchmark. The other part, it didn't. Conversely, on the large cap value side, the median manager outperformed the benchmark 77% of the time net of fees. So again, this goes to consistency. It's not just magnitude, but how often. And again, look at some of these strong numbers, particularly in SMID cap, small cap in the 80s, 90s percents, SMID cap 60s, 70s. And you can see here with international, closer to 60% of the time. So again, that's that consistency of outperformance. Fixed income, obviously, very much we're looking kind of, high 70s and not 80s and 90s. Does that make sense? So this is where page 8 and 9, this is basically the same thing I just showed you, except this is where we incorporate rolling 3 years. So now instead of looking just at since 2022, and it's kind of at the very bottom of these pages, you can see the disclaimer. But we go back to 1994. That's where we have the most data from. So that's almost 30 years. And what we do is we look at every rolling 3-year period over that almost 30 years. So every quarter we reset that. I already messed up on the month, so I'm not even going to do the math how many periods that is, but it's quite a bit. And then this is what the average median is over that time period. And we're showing both gross and net. So for instance, for example, the average since 1994, 3-year outperformance of large cap core on the left, gross of fees is 40 basis points. Net of fees is actually down 10 basis points. Okay. And what you can see as you look kind of across the page, these numbers tend to go up. So similarly, kind of what we've talked about, and again, this is the median manager. So half did better, half did worse. So we have a gross, but obviously we want to focus on net, right? I mean, that's what we're talking about, active management. How are you doing net of your fees? And so for instance, in the kind of, I won't go through every line, but you can see it, SMID cap core, where you have exposure. On average, the median manager outperforms by 80 basis points per year net of fees, right? And so you can see kind of, again, as we get more inefficient up to the right, you can see those numbers kind of pick up a little bit. And, for most SMID cap, non-US, we're somewhere between kind of right just under 1% to 1.5%, kind of even over 2%. Again, this is the average manager net of fees. If that makes sense. Okay. Page 9, similar thing, but again, consistency. What percentage of that time did they outperform? And so this is actually what we're looking, the median manager did what percent, the median manager, their 3-year return outperformed the benchmark. And again, we have gross and net. And so again, we switched some colors, so sorry for the confusion, but this page is the lighter blue that's net. So again, for instance, we can go, large cap core on or I should say, over this whole time period, 40% of the 3-year observations, the large cap core manager outperformed that fees. 60% of 10. But then kind of look again as you get more of these inefficient spaces. Small cap, 69, 59, 65. You get into small cap, 79, 76, 73, 88% non-US core. Again, the percent of the times, the median manager outperformed on a 3-year basis. So again, this is, when we talk about this, kind of why this is so important to us, it's basically stacking the odds. Right? I mean, kind of another way what you're saying is if I know nothing about a manager and I'm looking at non-US core, and I just, frankly, if I threw a dart, there's an 88% chance there's going to be outperformance net of fees over a 3-year period. And that's how you can kind of look at all these different ones.
Okay, looking at the outperformance, are we comparing this to an index? We're outperforming an index, or we're outperforming a passive approach?
So great question. All of these are relative to a specific index.
Index,
So
okay.
the index does not have fees associated.
Okay, so how does
In
that,
Analysis, the index doesn't have fees associated with it.
okay,
But if you were to buy an index fund,
Yeah.
there is a fee.
so we're looking at the performance of active management,
Yes.
50% better, 50% worse in the median for
Yes,
for the
that is the
active
median,
managers. Yeah. What does this tell me about comparing the active management to the passive management?
The best way you can,
Sorry if that's a stupid.
no, it's a great
It's
question.
good. That's why we
So-
want to do this.
Okay.
The best way to think about it, so this is versus an index.
Mm-hmm,
And so again, with index, there's no fees associated.
mm-hmm.
For pretty much all of these asset classes, we could invest in a passive index, but there would be a cost to that.
Mm-hmm.
And within the, the US large cap space, for instance, it's very low. It's, we get it for 1 basis point, 2 basis points. You get to small cap, fees go up a little bit. You get to international, and it grows by quite a bit. Particularly, it depends if we want to use an ETF, a passive mutual fund, but these could be tens of basis points. So in fact, it by showing versus a benchmark, this actually makes it harder for active management to outperform versus what you would actually be able to invest in passively. Does that make sense?
Because of the fees.
Because of the fees.
So just like the benefit of active management goes
Yeah.
up as you move across the page.
Right, right.
That's just the benchmark. The fees associated with the passive funds, in general, tend to get higher as you go from left to right across the page also.
Okay. Thank you.
That makes sense?
Yeah.
So I think you guys get the point, but the one thing I want to show on the next page, and then I'll kind of stop and just explain what the rest is. But so everything I've showed you so far is median management over the different time periods, et cetera, with again, the rank, the middle of the road is. And that's very important to know. But it's also very important to have expectations about what top managers can do and bottom managers can do. And that's what we're showing on this page, is I'm incorporating, and I'll explain this graph. But again, this is basically, it's the rolling 3-year. So going back to 94. So every, quarterly period, going back to 94 for 3 years. What that average median manager did in light blue relative to its benchmark. The green is the top quartile, so that's 25th percentile. The dark blue is bottom quartile, that's 75th percentile. So for instance, we talked about large cap being hard to outperform, active managers outperform. And we said the average excess, the median manager is about even, maybe slightly below the benchmark net of fees. Does that mean large cap active managers can't outperform? No, it means half do, half don't on average. And that's what you can see here. So that's kind of where, again, those green lines above, the average 25th percentile manager on a 3-year basis up about 2%. The bottom quartile is down to 2.5%. So a couple of things are important. Kind of know what your expectation is. It's also important to know that dispersion, right? If we're signing up for active management, at some point we're going to have a bottom quartile period. Hopefully more often than not, we're going to have a top quartile period. But we're going to experience that return dispersion over time. Right? And then again, the other thing to note is just again, as you continue to look to the right of the page, particularly until you get to the last four, and that's fixed income. I'll talk about that in a sec. But these other equity asset classes, those lines move up, right? So those median managers tend to be pretty much all cases outperform net of fees on average on a rolling 3-year basis relative to their benchmarks. So again, this goes to speak to why we like active management for certain spaces. Again, we think we can add a lot of value identifying managers, but in some ways, even if we were just to somewhat blindly pick, odds are in your favor, right? It's because of, again, kind of the inefficiencies in the space, information advantage, experience, history of managers, be able to, add strong performance. And then lastly, I've talked a lot about equity, but you saw the numbers earlier on fixed income. And so that bottom, those last 4 different fixed income asset classes, and really where our exposure is those first 2, core and core plus. That's what you see. It's a similar thing. More than half of the managers tend to outperform net of fees. But you can see that dispersion is pretty tight within fixed income, particularly within core fixed income, which listen, we would expect. We want our managers to certainly add value above an index. But listen, particularly this is kind of really the protection of our portfolio. We're not looking to take a lot of active necessarily risk there. Core plus fixed income, that gets into Western, so a little bit more. We see Western certainly bounce around that top and bottom quartile. But again, so again, just overall understanding those expectations at top and bottom quartile is important.
And the fees over here for active management are also, it doesn't matter if it's little fees, but they're also much lower.
Yeah, yes, great point. So the only thing I'll say, and happy to answer any questions, I won't necessarily take you through all this, but basically what the rest of the book is, and I'll just go through an example, is the data that's on this page. This page, so for instance, page 12. So page 12, this is US large cap core. And again, this is just showing you, and this goes back to 1994. This is this rolling 3-year excess return versus the S&P 500. And you can see the numbers up top. Like we said, on average, the median underperforms by 10 basis points. The 25th percentile on a 3-year period outperforms by 1.8. 75th underperforms by 2.1. But there are periods where there's ebbs and flows. And you can see that kind of throughout time. And we included kind of max and min for both the 25th percentile. 1 point, 25th percentile on, was up 8.5% on a 3-year basis versus the S&P. That was that was really kind of coming out of, 99 basically, as you were talking about earlier. But at 1 point also the 25th did underperform. And then you can see, and you can kind of scroll again as you go back in this book, the less efficient asset classes, for instance, page 17, SMID cap, 18. Again, you can just see over various periods of time, it does a little bit ebb and flow. So there are times when, broadly speaking, active management's more in favor. But again, kind of this is where the data set comes from and kind of goes to those top right of the information that we've kind of already shared and kind of went through. So overall, again, this data, we re-look at this every year. Certainly there are changes every year in terms of kind of the data, but over kind of long period of time, very much tends to rhyme. And ultimately, particularly in the smaller cap of the U.S., the international, continue to believe it makes sense to have active management kind of over time, net of fees, continuing to show value, certainly on the fixed income side as well. And yeah, Jody's great point too, that just because it's relative to a passive benchmark, it doesn't mean we can necessarily get that exact same passive exposure from that benchmark. There's fees associated with it. And sometimes for some of the other asset classes, like international small cap, there's really not even a great passive kind of implementation, just in terms of exposure. So I'll stop here. It's a lot of data. But again, this is something we do annually. We want to share with the board annually. Any questions?
In addition to looking at this analysis purely from a return perspective, is there a way to also factor in some of the risk profile of active management? And is that relevant? Where my mind's going a little bit is active managers, I think, have a little bit of a tendency as a lot to manage downside risk a little bit better than passive. And does that matter from an evaluation perspective? Does it matter for pension investors?
It's a great question. So we certainly, we always, as we look at, particularly in our quarterly books, we have the not just the volatility of our managers that we look at, the standard deviation, which is very important. You know, a lot of times you end up seeing that active managers not only are, they're judged over returns over a long period of time, but most of them are able to bring in some of that volatility in the portfolio. But also those, you know, I'm a big fan of that up-down capture matrix, right? That's if, you know, the benchmark's up 100, are you up more than that or less than that? The benchmark's more importantly down 100, are you down more, are you down less? And so we always continue to evaluate that. It's a little harder thing to package like this, but it's very, very important in terms of, is, you know, we look at active management and particularly, you know, okay, it makes sense to be active. When we look at individual managers, you know, we want, that's why the consistency is so important. Going back to that page, right? Because again, you can load up on, we're putting 100% of my, you know, portfolio into Facebook and it's going to be bad, bad, bad till 1 6-month period, it crushes it. And then all of a sudden I look great on a time series basis. Okay. But that's not consistency. That's not bringing in the risk. And so it's a great question. So the consistency kind of goes to it, but definitely when we evaluate individual managers for inclusion, then it's a huge, huge part of it. It's not just return.
I get you a question.
It does. I think ultimately, I guess the point is that making an active versus passive decision isn't 100% driven by pure performance results,
Right.
but a risk-aware investor might also factor in kind of the volatility metrics of
Right.
versus passive.
Up-down capture ratios as well as Sharpe ratios. Probably other elements as well.
So
Jerry, does that make sense?
So I take it net, at this point, you're not recommending that we shift our modus operandi, so to speak, our investment strategy.
no, I mean, like I said, going through this, so you look at this, okay, so we say it's tougher in the large cap space to add, and so kind of the bulk of our large cap assets are passively invested with online. But again, from the previous conversation we had earlier about diversification, we like having those two wing managers as well. But then kind of given what, you know, the returns we can get over time, and we have gotten over time from our managers, continue to like our approach elsewhere.
When you look at US large cap, based on the data that I saw, and maybe I misinterpreted the data, large cap value, you appear to have a better opportunity of outperforming the large cap value benchmarks than you do with growth.
Yeah, and I think part of that is a little bit more recently, just in terms of, you know, the large cap value benchmark, while, you know, more concentrated is not as concentrated as the Russell 1000 or given the conversation we had earlier. So a little bit, I mean, kind of at the end of the day, how it's come down to in large cap growth in particular is, do you own as much of the 7 as the benchmark?
Within value, do you look at deep value versus quality value? I mean, I know Aristotle's more in the quality value school.
So we do, yeah. And so that, you know, we do, so very much, you know, there's not only this, but we also, you know, we call playbooks for each individual asset class about it. And
Yeah.
Brian's point is there's a lot of ways to invest the value. And there's a lot of ways
If you're an
to
active
invest the
manager,
growth.
you're trying to outperform the value benchmarks.
Right.
I mean,
And so kind of how you would approach that. And so just kind of, you know, from a deep value perspective, we're not kind of great fans
Yeah.
of that. This plan, yeah. So.
Yeah.
Okay. All right, well, so you still have one more thing for me.
Oh, yeah, I guess.
And that's the investment policy statement. And again, this is something annually we take a look at and review. And really, there's just 2 updates we've added to this. The first is page 4. You know, first and foremost, you know, we do incorporate our, you know, actuarial required rate of return in this, which previously was 7.5, is now 7.25. And so part of that is just acknowledging that. Somewhat, you know, we changed a little bit of the language below, but again, just to mention kind of, you know, main goal for this is obviously we want to achieve this return target over a period of time, Again, it goes, you know, we didn't restate it, but back in kind of the first page, it talks about the overall goal of the plan, and that's to be kind of long-term, here for the beneficiaries of the portfolio, make sure our investments are set up to hit that.
You and I had a conversation about. It seems to me what's missing in the IPS is an expression of what we ultimately are trying to achieve. Yes, we want 7.25% to meet our obligations, possibly. But there's no expression that we ultimately want this plan to be fully funded. And I have to say, I haven't seen that, of course, there aren't that many consultants in that many pension plans. So I haven't seen that in many other IPS documents. Should that not be incorporated into our IPS, fully funded within X period of time? I just throw that out there. If we're not fully funded within X period of time, could be performance, could be that the county didn't put out enough money to allow us to be there. But that should be our overriding goal. That to me is the mission. The 7.25% is the annual return goal.
But the 7.25% gets you to, I mean, the way to get to fully funded, short of performance, is move the discount rate up to the level that gets you fully funded,
Or increase contributions.
or increase contributions.
Yeah.
And the difference between the discount rate and where the assets are at is what's driving contributions over time.
Right.
So if you wanted to reduce contributions, you have a higher discount rate, and,
But if our target, our mission is to be fully funded,
right?
and if we don't finagle the discount rate,
Right.
we have a realistic expectation of what the returns could be. Let's say it's 7.25. That gap expressed in dollars is what the county, incrementally is what the county has to put in. You say, we want to be at 90% funded. I call 90% funded. Want to be 90% funded in 5 years. And our 7.25% doesn't get us there in 5 years. So there's a gap there that has to be compensated for us.
Brian, if your point is that if there's an expression of the full funded status, that there's just a way to manufacture.
There are things outside of the investment policy that drive funding status. So I don't know if having that in the investment policy statement. I mean, it will be a contributor towards getting to fully funded,
Yes.
but we didn't vote for Prop P. I mean, I guess we voted for Prop P, but that has a bigger impact on the funding status than the investment returns.
You're looking at Jerry and thinking because
Just because he laughed.
the gold,
I got a giggle out of him.
the gold bullion he has in his basement along centered up in New Jersey.
And that's, I mean, I would
I
say
think
from
there has to be an expression of what overall this mission is to be. And that's a shared mission between the retirement board, which is an appendage of county.
Right.
And the executive or the legislative arm of the county.
But we're trying to deliver 7.25% returns, which drives the liability, right? So if you said you wanted to achieve full funding, that's going to be, I mean, if you set that discount rate artificially high and there's no ability for us to, I mean, if you set it at 20%, gosh, we're fully funded, but there's no way we would be able to achieve that, right, reasonable way to be able to achieve that return.
Totally agree. That's why I said we can't finagle with the discount rate. That has to be realistic.
Yes, but
Still have to have an expression of where we want to be in a certain period of time. The county has to have an expression.
I think there's more of a, I would say we don't see this office as more of a county discussion than an investment discussion. This is governing. Because there are a lot of things, whether it's, think about it, there's investment returns, there's contributions which you put in, there's benefits that you pay out. I mean, those last two levers aren't governed within here. I'm not saying it's not,
it seems like a chicken and the egg discussion, right? So if we say the reasonable level of return over time is 7.25%, that's our discount rate. That drives the denominator, okay? If you say, in addition to 7.25 being the target rate of return, that we want to get to full funding, that would mean that it would be our responsibility to get over 7.25%.
Or someone,
Over.
someone's full responsibility.
Right, or that would be our part, would be to get over the 7.25. But if we think we can reasonably get over 7.25%, discount rate should be higher, and therefore the funding level would be higher.
No, I believe 7.25 home, that's a co-responsibility, I think is what you said. You effectively said it's a co-responsibility.
Well, we vote on the, right, and so we say that's a return that we believe we can deliver. Okay, if you also put our objective is to achieve full funding through the investments, that the only way to do that would be to outperform the discount rate. In which case, if we reasonably thought we could outperform, the discount rate should be higher, and therefore funding status would be the benefit obligation would be lower, and the funding status would be higher.
Or the county puts in more money, which it doesn't have, but we're talking.
Yes,
about
right.
money. And someone would tell the county council, the only way this plan is going to be fully funded in 5 years, just pick a number of years, is that we achieve 7.25%. And you, the county, put in $15 million.
You bridge this out, they're doing it over 25 years over time.
You don't think we ought to express that it is the overall mission of this plan to be fully funded? And this is our investment strategy to execute our part of that.
I don't disagree with that. I'm just not sure it's appropriate in the investment policy statement. I think the discount rate is actually our expression because that's what drives the funding status.
So it was just simply changing the discount rate mentioned in the, hit that return target over time. And then just page 15, we're switching Sanderson to Silchester and a little bit of cleanup on benchmarks. Benchmark names, but otherwise everything as we kind of gone through continues to really make sense to be appropriate for this plan. That's why we do it every year.
Is this a voting item?
Yeah,
Or is this just
motion to
updates?
approve the policy statement.
Can I just make a quick comment? You know what's coming because you and I talked. So Penny was kind enough to give me an orientation, which I desperately needed. So thank you for that, coming on as a new board member. But we have monthly payouts of this portfolio. So there is a liquidity need in the portfolio, and there's not a lot of representation of the liquidity need and profile in the policy. And I just wonder if it should be. So at least there's a way to codify and recognize that there is a constant outflow, requiring the portfolio then to have adequate liquidity to fund those monthly payouts. And I'm just wondering if that should be incorporated into the policy as well.
Tony, I did talk about this, and my counsel, I mean, we can certainly add. I think I would be hesitant to put a cap on it, like X% of the portfolio needs to kind of, be liquid within a week and then a month. My thought more we kind of talked about was, incorporating maybe kind of, just, we talk about it a lot, but maybe just kind of formally a liquidity review of this person, this is the dollars that came out this year. This was the liquid within a week, a month, a quarter, liquid, et cetera.
I think even just something generic, and just, the plan needs to have adequate liquidity to fund the, recurring monthly benefit payments. That alone, I actually think is potentially sufficient. It's just we're silent on that right now. Unless Jerry's going to call me out on that. I don't know.
The realities are probably already doing it. So
It's just change in liquidity needs or funding trends will signal changes in portfolio objectives and a corresponding change in the planning horizon. It's not know what you're asking.
It's not quite.
Yeah.
I think we know that there's monthly payouts.
The county itself provides a lot of that on a monthly basis. I think at least 50% of them,
It does, yeah. We pull some. I mean, I think what
at least 50%, maybe it was more of the total payout of pension is provided by the county. So and the rest is provided by the corpus of the.
I mean, if the group would like, maybe it would make sense. So if you're on page 1, so number 2, if you go to B, well, this might be what you're talking about. But kind of over, so this is kind of very high level, and a lot of stuff falls under here, but it's designed to ensure a course of action, the highest probability of delivering retiree pension benefits. You know, we can include something like, you know, including, trying to think the best way to say it, but like the
Adequate liquidity
Adequate.
for short term, or to fund the current needs of the existing.
yeah.
I think that would do it, actually. And I think it's a good place to add it. I think that section.
Brian, could you repeat that?
Probably not. As policy designed to, what it reads, policy designed to ensure the course of action that has the highest probability of delivering retiree pension benefits at a reasonable overall cost to the county and its citizens. And to provide, and to ensure sufficient liquidity to meet the needs of current retirement benefits. Benefit options.
It would be an even more critical statement if we have a lot of.
Correct.
To meet current,
Current retirement benefits.
So reasonable overall cost of county citizens to ensure sufficient liquidity to meet current retirement benefits.
I think it would be, Brian said, a separate sentence after citizens, and maybe say, you know, this includes ensuring efficient liquidity to meet.
Yes, I was just teeing up when the first designed to ensure. So designed to ensure probability of retirement benefits, but also you can make it 2 sentences, that's fine, but
so just for the record, can we have the proposed language?
You two want to work on the language, and then we can approve this at the next meeting.
So,
that's fine.
I mean, nothing is going to change.
No.
Between now
Operational,
and the next
right,
meeting,
right.
operation. So if you can come up with language, Brian, that you think is satisfactory. That was written.
I see what you did there.
Hey, I'm the new guy. I don't know what I'm trying.
I've been playing that
Phineas,
for 5 years.
We'll write
Phineas,
something.
why don't you try to draft something?
Yeah.
Send it to Tony and Brian.
And if Brian approves, I'm good with it.
Then we would, in theory, approve this at the next meeting.
So again, not to belabor this, but I do think it's an important point, because for exactly what Milt said, by actually putting language in there, it means that we're recognizing the fact that we can't be 100%. So I think the addition is actually proven.
So we'll table that item for the next meeting, and might benefit to have a chair for that. Okay, so item 9, the drop task force update. The task force met in early September, and there will be a meeting scheduled for early October. Essentially, we left the first meeting with all task force members to complete their own individual research and bring back more information and ideas to the next meeting. Jerry or Karen, anything to add on that front?
No, I didn't.
No, it was a fascinating learning opportunity. I think everybody came, and Paul Bauer was in the meeting also. There's a lot of moving parts to this and a lot of different lenses to what different rock structures might look like and what would be most effective. It's good. The police department has one lens. Transportation, Public Works, and employees of St. Louis County might have a different lens. And so to understand the various versions of what might be appropriate overall. It should be a bit of a challenge, but good information coming.
All right.
Ditto. Yep.
Okay. Item 10, other business. Board member suggestions, requests for future agenda items, or things for discussion.
you brought it up a couple of times, but I think putting on the agenda for a chair would be appropriate.
Okay.
And if we can make nominations now, I'd like
You already know where that's.
Yeah.
Yeah.
You self-nominate yourself?
No, that's not what he's gonna do.
No, not at all.
I told you, I'm crowning myself.
No, I think if you bring it forward for new business, you rule yourself out as being.
Oh, I
chair.
see. I see.
I'll second.
I would suggest that the board send a letter to Jim Canane. Thanking Jim for his 5 years of service. It truly is service. Jim has a number of other things he's involved in, including running the finance council of the Archdiocese and prior being chair of the investment committee of the Archdiocese, which is even a larger pool of money than this is. He had a lot on his plate, and it was great of him to give his time to the board, which I truly appreciate. So
Consider it done.
would you like to draft that?
I'll take it.
Should we write one down, Emily, too?
I'm sorry, Jerry.
Yes.
Send them around to everyone.
Anything further? Item 11, correspondence was submitted. We had 3 items submitted to the board. Joyce Gula regarding cost of living adjustment, Rosemary Wilson regarding the retiree newsletter, and Emily Koenig's retirement board seat resignation.
Could I suggest also that we draft a letter to Emily?
Yes.
I'm sorry, is that what you said?
Yes.
I'm sorry, I couldn't hear you. That's what I was asking. So it'll be 2 others.
And section 12, visitor comments. As in county council meetings, individual visitor comments are restricted to 3 minutes. If the visitor has a question or comment regarding or requiring more time, please submit the question or comment in writing to Rebecca Smale of county staff. Any speakers today? David Bill.
Hi, my name is Dave Bilkin. I'm a county retiree. Good morning, everyone. Shortly after last month's meeting, when the board voted 5-2 to recommend a vote for retirees in 2024, thus providing all retirees a modest relief over the past 3 years, Mr. Wilkins, who voted in the minority, decided the minority view should hold sway. He then proceeded to recommend to county executive Page the nomination of Emily Pitts to the board. The county executive decided to have Ms. Pitts replace Mr. Canane, who had recently become board chair after Mr. Wilkins stepped down as chair. Evidently, Mr. Wilkins' ego allows him to delude himself that only he knows what the board should do and how it should do it. Unfortunately, Mr. Wilkins' action caused Ms. Pitts, who I assume is a competent and honorable person, to suffer the humiliation and embarrassment of not being confirmed to the board. Ironically, Mr. Wilkins is completely blind to the fact that he has long since outstayed his welcome on the board and needs to move on. Mr. Canane's term was over about 1.5 years ago, but Mr. Wilkins' original term expired in 2008, and then his new expiration date was 2014. That was 9 years ago. But Mr. Wilkins determines, in conjunction with Mr. Page, a person who just assumed the board chair should be replaced for an expired term of 1.5 years. The board needs new blood, but it's certainly not Mr. Canane who needed to be replaced. I'm sorry Mr. Canane got caught up in Mr. Wilkins' pettiness. Furthermore, just listening to this board discussion, Mr. Wilkins keeps bringing up this fantasy of full funding. Mr. Wilkins has been on the board for 16 years, and under his leadership, these 5-year terms, while we're going to get to full funding, hasn't even come into significantly. The last 25 years, and you guys can check this out, you never seem to want to. Last 25 years, at least 100 basis points under just discount rate. That's the average return of this pension. You are 100 basis points in the last 25 years, 100 basis points per year under the discount rate. And the nearest decade, you were only 5 basis points above the discount rate, 7.25. And some of those years, that discount rate was higher than 7.25. Thank you.
Any other stickers?
Do you want me to respond?
Mary-
Which is, I'm sorry.
Sorry, I saw Marion had her hand up.
No, let's, me
Can-
to respond.
Can I just,
Please, Brenda.
I can assure you, I mean, I wasn't in the room. I can assure you, that's not what happened. I've been on a number of boards with Milt for a long time. Committees, we have differences of opinion all the time. Jim's been on some of those committees as well. We all have a tremendous amount of respect for each other. And while neither one of us is shy about disagreeing with the other, we continue to be friends to this day. And so you can, I'm not going to change your thinking on this, but I can assure you that's not what happened. I don't know. I wasn't in the room, so I can't tell you, right? But I've known Milt for a long time. I've known Jim for a long time. That's not, I will categorically roll that out. I mean, yes.
Just for the record, I would also like to categorically say, I do not recommend Jim to leave this board. Not recommended, but not my decision. Didn't agree. So, sir, once again, you have stated things which are factually incorrect based on your own biases, not based on facts or evidence. How would you even know what would happen?
You didn't recommend.
We are gonna move on. Thank you. Any other speakers? Rosemary?
Marion, did you have
Or-
something?
Marion,
I'm just curious, after the August 29th meeting, I know Jim wrote the letter recommending the COLA that the retirement board had passed. That letter went to the county council, but I haven't seen anything on the agenda or heard anything since then. And I'm just wondering if you know what the status of that letter is.
No idea. But Marion, the county, based on prior cycles, the county's just into its budget process right now. And so I'm not sure you would see anything for quite a while. Because the constant ebb and flow of discussion between the county council and the county executive on the budget for next year, I don't think the budget for next year has been set for the county. And therefore, I wouldn't expect to see anything.
It's in the council's process and what they do, they have it and it's in their process and they take it from there.
And Jared just asked to confirm that that they've received it. Yeah,
I mean,
that they've received it. Yes.
The last time you recommended a COLA, what kind of time frame passed before the council recommended?
Just last year's a little different.
Last year was a little different. But it was
Into like
probably,
January.
yeah, it was into the following year. The time before, it was pretty smooth. Yeah.
You'd see it in the budgets, once they have a budget proposal. So if you watch the committee, the whole meetings during that, Mary, you would see it then.
Thank you. Any other speakers?
I would just say, my name is Joyce Bullock and I'm retired in St. Louis County. The only reason I submitted that is it's just some research that I had done and you're free to rip it up, read it, whatever you want to do. And I guess that's all I had to say. I did it, the date of it is November 22, but just comparing some of the other public pensions in Missouri.
Thank you.
All right. Item 13, the next meeting, regular board meeting will be Thursday, October 26th, 2023, in person here in these chambers at 9:30 a.m. and also available via WebEx. And our last item is adjournment. May I have a motion?
I move to adjourn.
Second.
All in favor?
Aye.
Questions? Thank you.
What now? We've submitted.
Unfortunately, I don't have.
No, I mean, they won't approve it. Once it gets